Pause for a moment and imagine this. What if you could take just $100, less than the cost of a night out, and turn it into $10,000, not in 10 years, not in 5, but starting right now in 2026? Most people think you need thousands of dollars, a finance degree, or insane luck to build wealth. But the truth is, you don't. The real secret is knowing where money is moving in 2026, which trends are exploding, and which investments can multiply quietly while you sleep. In the next few minutes, I'm going to show you the exact step-by-step strategy beginners are using to turn small investments into life-changing gains. If you've ever wanted a simple roadmap to grow your money, stay right where you are. Your financial transformation starts now. Imagine holding just $100 in your hands today. It doesn't feel like much, does it? You might think, how can this small amount ever grow into something meaningful? But here's the secret. It can grow into a significant sum if you understand the principles of money and investing. And not just slowly, it can grow faster than you might expect if approached correctly. Most beginners make the same mistake. They wait. They think they need hundreds or even thousands to start. They tell themselves, I'll start next month or when I have more money. But the truth is, wealth begins with a decision, not a number. It begins the moment you decide to take control of your financial future. That decision, right now, is more powerful than the $100 itself. Think of your $100 as a tiny seed in a vast field of opportunity. At first, it seems insignificant. You plant it carefully, water it, and protect it. Days go by, and you wonder if anything will ever happen. But slowly, over time, that seed sprouts. It grows into a sapling, then a tree, and eventually it bears fruit, sometimes far more than you imagined. That is exactly how your money works when invested wisely. To illustrate, let's look at an example from the real world. Imagine Sarah, a 25-year-old beginner investor in 2023. She started with $100 and added $50 each month to a diversified ETF portfolio. Within 3 years, her consistent effort turned that modest beginning into over $5,000. The principle is simple. Small, consistent actions compound over time. Now let's talk about mindset. Mindset is the true differentiator between successful investors and those who never see growth. Small money can grow into big money. Many beginners think they need $1,000 or $5,000 to make a meaningful investment. That's false. The secret is starting now, no matter how small. Even $5 a day invested consistently can grow into thousands over a few years. You are not trying to get rich in a week. The goal is not a quick windfall, but building a reliable structure that steadily grows your wealth. Investors who try to get rich overnight often lose money to hype, scams, and poor decisions. You don't chase hype. Social media, influencers, and trending stocks are tempting. But successful investors stick to a plan and ignore short-term noise. Let's take a real-world example of hype gone wrong. In 2021, meme stocks and cryptocurrencies surged overnight. People made quick gains. Many more lost their money by jumping in late or selling too early. Meanwhile, long-term investors in diversified ETFs and tech companies quietly grew their portfolios month by month. Nothing flashy, no hype, just steady growth. Another critical aspect of mindset is patience and resilience. Markets will dip, news will panic investors, and it's easy to feel impatient when others are making headlines with massive gains. But patience is a superpower. Those who wait, who continue investing during downturns, often see exponential growth when the market recovers. Finally, let's look at 2026, Technology is booming. AI is transforming entire industries. Companies that were small startups in 2023 are now massive players, dominating markets and creating incredible wealth for long-term investors. Apps and tools that were once reserved for professionals are now accessible to anyone with a smartphone. This is the perfect environment for beginners to start building wealth, even with just $100. So before we jump into specific investment strategies like ETFs, tech stocks, and dividends, remember this: your money will only grow if you help it grow wisely. This means using the right tools, adopting healthy investing habits, and preparing for both good and bad markets. Your journey begins today. That $100 in your hand is not just money, it's potential. And in the next chapter, we will explore how to set up your 2026 investing toolkit, ensuring every dollar you invest is working as efficiently as possible. Now that your mindset is aligned, it's time to get practical. To grow $100 into $10,000 in 2026, you need a solid investing setup, a toolkit that protects your money, maximizes growth, and makes investing as simple and consistent as possible. Think about it this way: imagine a carpenter without tools. Imagine a chef without a proper kitchen, or a gardener without seeds and soil. No matter how talented you are, without the right tools, success is limited. The same applies to investing. Beginners who skip this step often struggle, not because they lack potential, but because they aren't properly equipped. The first tool you need is a reliable, beginner-friendly investing platform. In 2026, this means apps and brokers that offer fractional share investing, automatic deposits, low or zero commissions, and access to a wide variety of assets, including ETFs, index funds, and tech stocks. Apps like Fidelity, Vanguard, Schwab, Webull, and Robinhood are excellent choices. These platforms make investing easy for beginners while offering advanced tools as you grow. Next, you need a recurring investment plan. Even if you only start with $100, the key is consistency. Setting up automatic deposits, say $20 per week or $50 per month, ensures you never miss a contribution. This not only builds wealth faster, but also creates a habit. Think of it as paying yourself first. Just like you would consistently pay bills, investing becomes a regular automatic activity. Then, decide your investment style. There are three main approaches. 1. Passive investing. Buy ETFs and index funds and let them grow over time. Minimal effort, consistent results. 2. Semi-active investing. Select a few high-potential stocks in sectors like AI or tech, while keeping most funds in ETFs. Balanced risk with growth potential. 3. Active investing. Daily stock picking, trading, and trying to time the market. Not recommended for beginners with $100, as it's risky and time-consuming. For our purpose, we'll focus on passive and semi-active investing because they balance safety with growth potential. Another important component of your toolkit is risk management rules. Before investing, decide how much money you can afford to lose without affecting your life, what your target return is for 2026, how you will react if the market dips or surges. This prepares you emotionally and strategically. Beginners often panic sell during a dip or chase trends during a spike, which destroys returns. Having rules prevents these mistakes. Finally, consider educational resources and tracking tools. In 2026, there are apps and websites that use AI to provide insights, projections, and personalized recommendations for your portfolio. Using these resources helps you make informed decisions without getting overwhelmed by information. Once your toolkit is fully set up, you're ready to take action. Your next step is learning the safest and most beginner-friendly way to grow your money in 2026. Index funds and ETFs, which we'll dive into in the next chapter. Now that you're equipped with the right tools and habits, it's time to put your $100 to work in a safe, structured way. Think of your toolkit as the foundation of a house. Without it, the walls may crumble. But with it, you can start building upward with confidence. The next chapter will show you exactly how to start growing your money with index funds and ETFs, giving you stability while still participating in market growth. Now that your investing toolkit is ready, it's time to take action. The first and safest place to start growing your money is through index funds and ETFs. Think of investing in an ETF like planting a forest instead of a single tree. Rather than betting all your money on one stock that could fail, an ETF is a basket of hundreds or even thousands of companies. By investing in an ETF, you spread your risk while still giving your money a chance to grow steadily. This is what professional investors call diversification, and it's one of the most reliable strategies for beginners. Let's break it down with an example. Suppose you invest your $100 in an S&P 500 ETF. This ETF holds shares from the 500 largest companies in the US, including Apple, Microsoft, Amazon, and Tesla. Even if a few of these companies have a bad year, the rest continue growing, protecting your overall investment. Over time, historically, the S&P 500 has returned an average of 10% per year. That's not a guarantee for 2026, but it shows the power of diversified investing. Now let's talk about some of the best ETFs for 2026. S&P 500 ETFs, VOO, SPY, IVV. Track the top 500 US companies. Safe, stable, and historically reliable. Total market ETFs, VTI, SCHB, ITOT. Include large, mid, and small cap companies across the US, offering broader exposure. Growth ETFs, QQQ, VUG, ARKK. Focus on tech and AI-driven companies. Higher risk, higher potential reward. International ETFs, VXUS, IXUS, VEU. Diversify outside the US, capturing growth in emerging and developed markets. Dividend ETFs, SCHD, VYM, HDV. Provide a steady stream of quarterly income while holding stable, high-quality companies. Here's how a beginner might structure their $100 initial investment in 2026. $60 in a safe, stable ETF like VOO or VTI. $30 in a growth-focused ETF like QQQ or ARKK to participate in the tech and AI boom. $10 in a dividend-focused ETF like SCHD to start building passive income. By doing this, you balance safety, growth, and income, the three pillars of a smart investing strategy. Now, many beginners wonder, why ETFs instead of individual stocks? Well, individual stocks can be exciting. Picking the next Tesla or Apple sounds tempting. But the reality is, beginners often overestimate their knowledge and underestimate risk. A single bad decision could wipe out months or years of savings. ETFs, on the other hand, provide a built-in safety net while still offering long-term growth. Another advantage in 2026 is automation. Most investing apps allow you to set recurring purchases of ETFs. This means you can automatically invest $20 or $50 each month without thinking about it. This set-it-and-forget-it approach removes emotional bias from investing, a major reason many beginners fail. And let's not forget the magic of compound growth. Even a small $100 investment can snowball over time. If your ETFs grow 8 to 10% annually and you consistently add more money, your initial seed can become thousands of dollars within a few years. That's the power of consistency and diversification combined. By now, you're seeing how a structured, safe approach in 2026 can grow your money steadily. But if you want faster growth, you also need to tap into high-potential sectors. That's where technology and AI come in. The next chapter will dive into the 2026 tech boom and how it can accelerate your wealth growth. Now that you understand the safety and power of ETFs, it's time to look at the fastest growing opportunities in 2026, technology and AI. While ETFs provide stability, tech and AI investments give you a chance to accelerate your returns. Think of ETFs as the solid foundation of your financial house, and tech stocks as the high towers that can reach incredible heights. In the next chapter, we'll explore which tech sectors are booming in 2026 and how to position yourself for maximum growth. Now that you understand the safety and consistency ETFs provide, it's time to explore the fastest growing opportunities in 2026, technology and AI. While ETFs give you stability, tech and AI investments offer the potential to accelerate your wealth growth, sometimes exponentially. Technology is evolving at a pace we've never seen before. Artificial intelligence, automation, cloud computing, and robotics are not just buzzwords. They are reshaping industries, creating new companies, and disrupting old markets. Every day, new AI-driven applications, software, and platforms are emerging, and investors who position themselves now could reap enormous rewards over the next few years. Let's break down the most promising tech sectors in 2026. 1. AI infrastructure. Companies that provide the hardware, software, and tools for AI are booming. Think of NVIDIA and AMD, which produce GPUs essential for AI computations. Without these companies, AI wouldn't function efficiently. Investing in infrastructure means your money benefits from the growth of the entire AI industry, not just one product or service. 2. Cloud computing. Platforms like Amazon AWS, Microsoft Azure, and Google Cloud are the backbone of modern AI and tech applications. More businesses are moving operations to the cloud, which is expected to grow rapidly in 2026. Cloud companies benefit every time a startup launches, an app scales, or a business adopts AI tools. 3. Robotics and automation. Automation is taking over repetitive tasks in manufacturing, logistics, and even services. Companies like Tesla, ABB Robotics, and Boston Dynamics are at the forefront of this revolution. Investing in automation not only taps into growth, but also prepares your portfolio for a world where efficiency and AI integration dominate. 4. Cybersecurity. With AI and cloud adoption comes new risks. Protecting sensitive data has become more important than ever. CrowdStrike, Palo Alto Networks, and Fortinet are leading cybersecurity providers, and their growth potential in 2026 is massive as more companies invest heavily in protecting themselves. 5. AI software platforms. Microsoft, Google, and Adobe are integrating AI into everyday tools, making businesses and individuals more productive. These companies dominate markets with reliable revenues and consistently innovate to maintain their advantage. Now, you might wonder, should I invest my $100 in these individual tech companies directly? The answer depends on your risk tolerance. Investing directly in tech can be more volatile than ETFs. Prices can swing dramatically with news, regulations, or competition. That's why many beginners balance their portfolio: ETFs for stability, tech for growth, and maybe a small portion in AI stocks for higher risk, higher reward potential. Let's look at a real-world example. In 2023, a beginner investor put $50 in a tech ETF and $50 in individual AI-related stocks. By 2026, the tech ETF grew steadily at 8 to 10% per year, while the AI stocks, though volatile, occasionally doubled in value during key product launches. The combination of steady ETFs and high-growth tech stocks accelerated overall portfolio growth far beyond traditional investments alone. Another advantage of investing in 2026 is access to information. Unlike 20 years ago, you don't need insider knowledge to research companies. AI tools can help analyze earnings reports, predict trends, and even suggest which companies are undervalued. This levels the playing field for beginners and gives you a huge advantage. However, higher returns come with higher risk. Tech and AI companies can rise rapidly, but they can also fall if a product fails, regulations change, or competition intensifies. That's why diversification and proper research are critical. By combining ETFs, dividend stocks, and carefully selected tech investments, you create a balanced portfolio that can grow steadily while capturing high-growth opportunities. And here's the exciting part. Tech and AI are not a short-term trend. Experts predict massive expansion throughout 2026 and beyond. AI adoption in healthcare, finance, manufacturing, and entertainment is accelerating, creating multiple opportunities for investors who understand where the growth is happening. By positioning yourself now, even a $100 investment can compound over time into a significant sum. This naturally leads us to the next step, dividend investing, which allows you to earn passive income while you hold both ETFs and tech stocks. Dividend investments act like a safety net, giving you cash flow even during volatile market periods. So far, you've learned how ETFs provide stability and how tech and AI offer high growth potential. But growth alone isn't enough. You need cash flow from dividends to make your money work for you, even when you're not actively investing. In the next chapter, we'll explore dividend investing and how it helps you generate steady income while compounding your wealth. Now that we've explored ETFs for stability and tech stocks for growth, it's time to add another powerful element to your portfolio, dividend investing. Think of dividends as your money working for you, even when you're not actively buying or selling stocks. Dividend investing is simple to understand, but incredibly effective over time. Certain companies, typically established, financially stable ones, pay a portion of their profits back to shareholders in the form of dividends. These payments usually occur quarterly, but some companies even pay monthly. For beginners, dividends are a way to generate passive income while your investments continue to grow. Let's put this into perspective with an example. Imagine you invest $100 in a dividend-paying ETF like SCHD or VYM. These ETFs hold shares from dozens of companies known for stable and consistent payouts. Within the first year, you might receive just a few dollars in dividends. But if you reinvest those dividends, buying more shares, your portfolio starts compounding faster. It's the classic power of money making money. Why is dividend investing particularly valuable in 2026? Because market volatility is expected to increase. With rapid tech adoption, AI innovations, and geopolitical factors, stock prices may swing significantly. Dividend stocks act as a buffer. They provide income even when market prices fluctuate. Investors often describe this as getting paid to wait. You hold your shares, let the market move naturally, and still earn money. Here's how you can start dividend investing as a beginner. 1. Choose dividend ETFs. SCHD, VYM, and HDV are excellent for beginners. They diversify your holdings across multiple companies, reducing risk while ensuring steady payouts. 2. Consider individual dividend stocks. Companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble have long histories of paying and increasing dividends each year. Even small investments can start building income streams. 3. Reinvest dividends. This is critical. By automatically reinvesting dividends, you buy more shares, increasing your future dividend payouts and accelerating growth. 4. Balance dividend stocks with growth investments. Dividend stocks may not skyrocket like tech companies, but they reduce risk and create stability in your portfolio. Let's look at a real-world scenario. Emily, a beginner investor in 2023, invested $100 in a dividend ETF and added $50 each month. By 2026, She not only benefited from capital appreciation in the ETF, but also had a steady stream of dividend payouts. She reinvested every dividend, which accelerated her portfolio growth. This simple habit turned small monthly contributions into a surprisingly large amount over just 3 years. One important tip for 2026: look for dividend growth. Companies that consistently increase their dividends tend to be financially healthy and resilient. These companies provide both income and growth potential, making them ideal for beginners with limited capital. Dividend investing also teaches a valuable lesson: patience pays off. Unlike volatile tech stocks that might double or halve in value, dividend stocks reward you steadily over time. They're a reminder that building wealth isn't always about instant gains, it's about consistency and compounding. By combining ETFs, tech growth stocks, and dividend-paying assets, you create a portfolio that is both aggressive enough to capture growth and stable enough to weather market fluctuations. This strategy sets the stage for the next chapter, where we'll outline the $100 to $10,000 blueprint, showing exactly how to structure your investments in 2026 for maximum results. With dividends adding stability and growth stocks offering high potential, it's time to put all the pieces together. In the next chapter, we'll reveal the $100 to $10,000 blueprint, a clear, step-by-step plan showing exactly how much to invest, where to allocate your funds, and how to combine ETFs, tech, and dividends to grow your money consistently in 2026. Now that you've learned about ETFs, tech stocks, and dividend investing, it's time to combine everything into a clear, actionable blueprint. This is where your $100 begins its journey toward $10,000 in 2026. First, let's address the big question. Is it really possible to turn $100 into $10,000? The answer is yes, but it requires strategy, patience, and consistent action. We are not talking about gambling, day trading, or get-rich-quick schemes. Instead, we are talking about a well-structured investment plan that leverages compound growth, diversified assets, and recurring contributions. Here's how the blueprint works. 1. Step 1. Start small. Start now. Begin with your $100. Open a beginner-friendly investment account with a broker like Vanguard, Fidelity, or Robinhood. Allocate your $100 strategically. $60 in a stable ETF like VOO or VTI. $30 in growth-oriented tech or AI-focused ETFs or stocks like QQQ or ARKK. $10 in a dividend-focused ETF like SCHD or VYM. Step 2. Set up recurring contributions. Even small, consistent contributions have a huge impact. For example, adding $50 per week or $200 per month may seem small at first, but over time, these contributions compound with growth and dividends to accelerate your portfolio. Step 3. Reinvest dividends. Every penny of dividend income should be reinvested to buy additional shares. This simple habit magnifies returns over time and keeps your portfolio growing steadily, even during periods of market volatility. Step 4. Allocate smartly. Keep a balance between stability and growth. 50 to 60% in ETFs for long-term stability. 30 to 40% in growth tech/AI investments for high potential returns. 10% in dividend-paying assets to generate passive income. Step 5. Track progress and adjust. Monitor your investments quarterly. If certain sectors are underperforming or overexposed, adjust allocations slightly. Don't chase hype, but stay informed about emerging 2026 trends, such as AI startups, biotech breakthroughs, or cloud computing innovations. Let's see a hypothetical example of how this works in 2026. Initial investment, $100. Weekly contribution, $50. $200 per month. Annual return from ETFs, 8 to 10%. Annual growth from tech, AI stocks, 15 to 25%. Variable, higher risk. Dividends reinvested, 2 to 3% annual yield. After 1 year, your portfolio could grow to approximately $1,500 to $2,000. By the end of year 3, with consistent contributions and compounding, your portfolio could surpass $6,000 to $8,000, depending on market performance. By year 4 or 5, you may reach the $10,000 milestone if you continue contributing, reinvesting, and holding steady. One key takeaway is that time and consistency are more powerful than luck. You don't need massive amounts of starting capital. You don't need insider knowledge. What you need is a plan, discipline, and a clear structure, all of which this blueprint provides. Now, many beginners ask, what about risk? The truth is, every investment carries risk. But by diversifying across ETFs, tech growth stocks, and dividend-paying assets, you dramatically reduce the chance of losing money while still capturing growth. Think of it like a 3-layer shield. ETFs protect, tech accelerates, and dividends provide steady cash flow. Finally, this blueprint sets the stage for further acceleration strategies. Once your portfolio reaches a solid base, you can explore leverage, sector-specific investments, or high-growth startups. But before we go there, it's important to fully master the basics and establish your $100 to $10,000 foundation. With your blueprint in place, you now have a clear path to grow your $100 into $10,000. But the journey doesn't stop here. In the next chapter, we'll explore high-risk, high-reward strategies for 2026, including emerging industries, micro-investing in AI startups, and other innovative ways to accelerate your wealth once the foundation is secure. Now that your 100 to 10,000 blueprint is in place and you're consistently investing in ETFs, tech stocks, and dividend assets, it's time to explore high-risk, high-reward strategies for 2026. These strategies are not mandatory. They carry more risk than your core portfolio, but if used wisely, they can accelerate growth significantly. First, let's define what high risk really means. High-risk investments are assets that can fluctuate dramatically in value over a short period. You could see substantial gains or losses. That's why these strategies are best used after your core investments are established. Think of it as a growth engine on top of your stable portfolio. Here are the most promising high-risk, high-reward opportunities in 2026. 1. Emerging AI startups. The AI revolution is creating thousands of new startups every year. Some are focused on chatbots, automation tools, generative AI, or AI-driven healthcare solutions. Platforms like Seed Invest, Republic, or WeFunder allow you to invest small amounts in early-stage companies. While many startups fail, a single success can multiply your investment dramatically. 2. Cryptocurrency and Web3. Digital currencies remain volatile but offer huge potential. In 2026, stablecoins, decentralized finance platforms, DeFi, and AI-driven blockchain projects are gaining traction. The key is to invest cautiously, diversify across several projects, and only use money you can afford to lose. 3. Sector-specific ETFs. Instead of broad ETFs, consider niche ETFs targeting emerging industries such as AI robotics, green energy, or biotech. These ETFs carry higher volatility but align with the fastest-growing trends of 2026. 4. Options trading. Beginner-friendly. While traditional options trading is risky, simple call and put strategies can be used to leverage gains on high-conviction tech stocks. Beginners should start with small amounts, paper trade first, and only invest what they're willing to risk. 5. Micro-investing platforms. Apps like Public, Acorns, or Stash allow you to invest spare change or fractional shares in high-potential companies. Over time, even small amounts can grow if invested strategically, especially in emerging sectors. Now, it's important to manage risk carefully. Even though these investments are exciting, they should only make up 10 to 20% of your total portfolio. Your ETFs, dividend stocks, and tech core remain the foundation. Think of high-risk strategies as rocket boosters. They can propel your wealth faster, but should not compromise the safety of your base. Let's look at a real-world example from 2023 to 2025. Alex invested $100 in a stable ETF, $50 in tech stocks, and $20 in a fractional investment in an AI startup. Within 2 years, the ETF grew steadily. The tech stocks doubled in value, and the startup investment multiplied 5 times when the company secured a major contract. By balancing risk and reward, Alex accelerated overall portfolio growth without jeopardizing the core stability. Another crucial tip: research is your best friend. High-risk investments are exciting, but knowledge prevents reckless decisions. Follow market trends, read expert analyses, and keep an eye on emerging 2026 technologies like AI-driven healthcare, autonomous transportation, or generative media. Lastly, don't let short-term swings affect your strategy. Volatile assets can experience rapid ups and downs, but successful investors stay focused on long-term potential. By keeping the majority of your portfolio in stable ETFs and dividend stocks, you can afford to ride out volatility without panic selling. With high-risk, high-reward strategies integrated carefully, your portfolio is now balanced for stability, growth, and potential acceleration. In the next chapter, we'll explore emerging trends and sectors in 2026 that are expected to dominate the market, helping you make smarter, future-focused investments and ensuring your $100 investment grows as efficiently as possible. Now that your portfolio balances stability, growth, and high-risk opportunities, it's time to focus on emerging market trends in 2026. These trends are shaping the economy, creating new investment opportunities, and providing early movers with massive potential for wealth growth. Understanding these trends can give you an edge, allowing your $100 investment to grow faster and smarter. In 2026, the world is evolving rapidly, and several sectors are poised for extraordinary growth. Let's break them down. 1. Artificial intelligence everywhere. AI is no longer limited to chatbots or research labs. It's becoming integrated into healthcare, finance, logistics, and entertainment. Companies developing AI solutions for predictive analytics, personalized recommendations, and automation are expected to see explosive growth. Investing in AI-focused ETFs or companies targeting specific AI applications can position your portfolio ahead of the curve. 2. Green energy revolution. Climate-conscious technologies are booming. Solar, wind, battery storage, and electric vehicle infrastructure are key sectors. Governments and corporations worldwide are committing billions to sustainability projects, creating a fertile ground for investors. ETFs focusing on renewable energy or EV tech stocks are expected to perform exceptionally in 2026. 3. Biotech and healthcare innovation. Post-pandemic, healthcare innovation continues at an unprecedented pace. Gene editing, AI-assisted diagnostics, wearable health devices, and telemedicine are all high-growth areas. Small biotech firms may offer high-risk, high-reward opportunities, while ETFs provide safer exposure. 4. Decentralized finance, DeFi, and Web3 applications. Blockchain technology is expanding beyond cryptocurrency. In 2026, DeFi platforms, NFTs for business, and AI-driven blockchain solutions are expected to gain mainstream adoption. Investing cautiously in this space can be rewarding if you stay informed and diversify. 5. Automation and robotics. The global demand for automation is rising in manufacturing, supply chain management, and even service industries. Companies producing robotics hardware, AI-integrated machinery, or software for process optimization are ripe for growth in 2026. 6. Educational technology, EdTech. With digital learning continuing to expand, AI-powered education platforms, online skill-building apps, and gamified learning tools are becoming essential. This trend has massive potential as more students and professionals seek flexible, tech-driven learning solutions. Now, let's consider how to apply these trends to your investment strategy. Allocate a portion of your portfolio to ETFs or stocks that track these emerging sectors. For example, a renewable energy ETF or a biotech ETF provides exposure to fast-growing industries without concentrating risk on a single company. Consider small, carefully researched, high-risk investments in promising startups or early-stage companies within these sectors. Even tiny allocations can provide outsized returns if the company succeeds. Use AI tools and market research platforms to monitor performance, track emerging opportunities, and stay updated on sector developments. The key here is timing and research. Emerging trends offer enormous growth, but they also come with volatility. By combining these trends with your stable ETFs, dividend-paying assets, and selective high-risk investments, your portfolio becomes both future-proof and growth-oriented. It's also worth noting that 2026 is a year of digital acceleration. AI, automation, and Web3 are not trends. They are long-term transformations. Investors who position themselves wisely now can benefit from multi-year growth cycles instead of chasing short-term hype. With a strong understanding of emerging 2026 market trends, you're now equipped to strategically allocate funds for maximum growth and safety. In the next chapter, we'll cover advanced portfolio strategies, showing how to combine ETFs, tech, dividends, and emerging sectors into a cohesive investment plan that maximizes your chances of turning $100 into $10,000. Now that you understand emerging 2026 market trends, it's time to elevate your investing game with advanced portfolio strategies. These strategies are about optimizing your portfolio for growth, stability, and adaptability. By combining what you've learned, ETFs, tech stocks, dividend investments, high-risk opportunities, and emerging trends, you can create a portfolio that maximizes your potential to turn $100 into $10,000 and beyond. Core and satellite strategy. This is one of the most powerful approaches for beginners and intermediate investors. Here's how it works. Core. The core portion of your portfolio, about 60 to 70%, is in stable ETFs and dividend-paying assets. This is your foundation, steady, low-risk growth that cushions your portfolio against market volatility. Satellite. The remaining 30 to 40% is in higher-risk, high-reward investments, tech and AI stocks, emerging sector ETFs, or carefully researched startups. This is your growth engine, designed to accelerate your returns. This strategy allows you to capture upside potential without risking your entire portfolio. Think of it as building a strong ship that can weather the storms, while also carrying a few speedboats that explore new waters. Sector rotation. Another advanced strategy is sector rotation, where you adjust your investments based on economic cycles and market trends. In 2026, certain sectors like AI, cloud computing, and renewable energy are expected to outperform, while others may lag. By periodically reallocating funds from underperforming sectors to high-potential ones, you can optimize returns while staying diversified. Dollar cost averaging, DCA, consistency is key. DCA involves investing a fixed amount regularly, regardless of market conditions. By doing this, you automatically buy more shares when prices are low and fewer shares when prices are high. Over time, this reduces the impact of market volatility and ensures you stay invested without trying to time the market. 4. Rebalancing your portfolio. As 2026 progresses, some investments will grow faster than others, causing your original allocation to shift. For example, your tech stocks may outperform ETFs, making your portfolio riskier than intended. Rebalancing involves selling portions of outperforming assets and buying underperforming ones to restore your target allocation. This keeps risk in check while maintaining long-term growth potential. Using AI tools for portfolio management 2026 offers unprecedented access to AI-driven investment tools. Platforms like Wealthfront, Betterment, and Personal Capital use AI to suggest optimal allocations, forecast trends, and manage risk. Some tools can even analyze emerging sectors, predict growth patterns, and recommend adjustments tailored to your goals. Leveraging these tools can help you stay ahead of the market while saving time and effort. 6. Tax-efficient investing. Taxes can eat into your returns if you're not careful. In 2026, use tax-advantaged accounts like IRAs, Roth IRAs, and 401ks for long-term investments. Additionally, consider tax loss harvesting, selling underperforming assets to offset gains and reduce your tax liability. This may sound advanced, but even beginners can benefit from simple tax-efficient practices. Psychology and discipline. Advanced investing isn't just about numbers, it's about mindset. The ability to stay calm during market fluctuations, avoid emotional decisions, and stick to your strategy is what separates successful investors from unsuccessful ones. Remember, in 2026, the markets may be volatile, especially with tech and AI stocks, but discipline ensures your growth trajectory remains on course. Here's a practical example of applying advanced strategies in 2026. Core, 60%, $600 in S&P 500 ETF, VOO plus dividend ETF. Satellite, 30% in AI tech ETF, and selected high-growth AI startups. High-risk speculative, 10%, $100 in emerging biotech or Web3 startups, with DCA, rebalancing every 6 months, and reinvesting dividends. Your portfolio grows steadily while capturing high-growth opportunities. Even modest contributions over 12 to 24 months could move your $100 investment toward the $10,000 goal, depending on market performance. With advanced portfolio strategies in place, you now have the tools, mindset, and structure to grow your investments systematically. But to truly maximize gains in 2026, you also need to understand risk management and protective strategies. In the next chapter, we'll explore how to safeguard your investments, minimize losses, and protect your capital during volatile market periods. By now, your portfolio is shaping up nicely with a mix of ETFs, dividend stocks, tech growth, emerging sectors, and even some high-risk opportunities. But even the best investment strategies can face setbacks if risk is not properly managed. In 2026, market volatility is expected to remain high due to AI innovations, geopolitical shifts, and rapid technological disruptions. That's why risk management is not optional. It's essential. 1. Diversification is your first line of defense. Diversification means spreading your investments across different asset classes, sectors, and geographies. For instance, ETFs for broad market exposure, dividend stocks for steady income, tech and AI stocks for growth, emerging market or sector-specific ETFs for high potential, optional high-risk micro investments in startups or crypto. By not putting all your eggs in one basket, you reduce the impact of any single loss. Even if one stock or sector underperforms, your overall portfolio remains protected. 2. Set stop-loss levels for high-risk investments. High-risk assets like individual tech stocks, AI startups, or cryptocurrencies can be volatile. Setting stop-loss orders, automatic sell points at predetermined prices, can limit losses. For example, if a stock drops 10 to 15%, your stop-loss can trigger a sale, protecting you from further decline while keeping the majority of your portfolio intact. 3. Maintain a cash reserve. Keeping a small portion of your portfolio in cash or cash equivalents, 5 to 10%, provides a safety net and flexibility. If markets suddenly drop, you can avoid panic selling and even use the cash to buy undervalued assets at lower prices, maximizing your long-term returns. Regular portfolio reviews. Markets evolve quickly, especially in 2026 with AI, automation, and emerging tech shaping industries. Set a schedule to review your portfolio quarterly. Check for overexposure to a single sector, underperforming investments, opportunities to rebalance or reinvest dividends. Regular monitoring ensures your strategy adapts to changing market conditions without emotional decisions. Hedging opportunities. Advanced investors sometimes use hedging strategies to protect against downside risk. For beginners, this could be as simple as allocating a small portion to inverse ETFs that rise when the market drops, using gold or other safe haven assets to balance volatility, diversifying globally to reduce domestic market risk. The goal is not to avoid losses entirely, but to reduce their impact while staying invested for long-term growth. 6. Stay emotionally disciplined. Market swings can trigger fear or greed. In 2026, AI-driven market analysis and social media hype may amplify emotions. Avoid impulsive decisions like selling tech stocks after a dip, chasing the latest high-risk trend, ignoring your long-term plan because of short-term news. Successful investing is as much psychological as financial. Staying disciplined, following your blueprint, and adhering to risk management rules protects both your money and your mindset. Insurance through knowledge. Finally, risk management isn't just about numbers, it's about education and awareness. Stay informed about market conditions, emerging trends, and regulatory changes in AI, tech, biotech, and renewable energy. Knowledge allows you to anticipate risks, adjust allocations, and make confident decisions in 2026's rapidly changing landscape. With effective risk management strategies in place, your portfolio is now strong, adaptable, and resilient. The next step is maximizing growth potential through compound returns, reinvestment strategies, and smart timing techniques, ensuring your $100 investment continues to accelerate toward the $10,000 milestone. Now that your portfolio is diversified, balanced, and protected with strong risk management strategies, it's time to focus on maximizing growth potential. After all, the goal is not just to preserve your $100 investment, but to turn it into $10,000 or more in 2026. This chapter will show you actionable strategies to accelerate compounding, optimize returns, and take advantage of high-growth opportunities. 1. Reinvesting all returns. Reinvesting dividends, interest, and capital gains is one of the simplest yet most powerful growth strategies. Every dollar you reinvest buys additional shares, which then generate more dividends and gains, creating a snowball effect. In 2026, this is especially effective because emerging sectors like AI and renewable energy are expected to have above-average growth, magnifying the benefits of reinvestment. Leveraging dollar-cost averaging, DCA, consistency is critical for growth. DCA involves investing a fixed amount regularly, regardless of market conditions. This strategy ensures you buy more shares when prices are low and fewer when prices are high, reducing the impact of volatility and increasing long-term returns. For example, adding $50 weekly to your core ETFs and high-potential stocks steadily compounds over months and years. Tapping into emerging sectors for accelerated returns. While your core portfolio provides stability, carefully allocating a portion to high-growth emerging sectors in 2026, like AI, biotech, clean energy, or automation, can significantly boost your portfolio's trajectory. By following trends, analyzing early-stage companies, and using sector-specific ETFs, you can capture upside that traditional investments might miss. Portfolio rebalancing for growth optimization. Rebalancing is not just about risk management, it's also a growth tool. Over time, your growth assets may outperform your stable investments, making your portfolio riskier. Rebalancing involves selling portions of overperforming assets and buying underperforming ones. This ensures your portfolio remains aligned with your goals and allows you to buy quality assets at lower prices, maximizing growth potential. 5. Compound interest magic. Albert Einstein famously called compound interest the eighth wonder of the world. The earlier and more consistently you reinvest, the more your money grows exponentially. For instance, reinvesting dividends from ETFs, tech stocks, and high-growth sectors, even small amounts, can result in substantial portfolio growth over 12 to 24 months, accelerating your $100 into thousands. Smart use of high-risk opportunities. High-risk investments are your rocket boosters, but they need to be managed carefully. Allocate no more than 10 to 20% of your portfolio to speculative assets like AI startups, emerging tech, or cryptocurrencies. When one of these succeeds, it can significantly boost your total portfolio without jeopardizing your stable core. The key is patience, research, and disciplined allocation. 7. Tracking and optimizing performance. Use tools like personal finance apps, AI investment advisors, and spreadsheet tracking to monitor growth. Track which sectors, ETFs, or stocks are performing well, and adjust contributions or allocations accordingly. Being proactive ensures your portfolio isn't just growing, it's growing efficiently and strategically. The power of time. Finally, maximizing growth isn't just about where you invest, it's also about how long you stay invested. In 2026, markets may experience volatility, but staying invested, reinvesting gains, and following your blueprint allows compounding to work its magic. Even small investments like $100, combined with consistent contributions and disciplined strategies, can produce remarkable results. With growth maximization strategies in place, you now have all the tools to accelerate your investment journey. In the final chapter, we'll combine everything you've learned into a step-by-step action plan for 2026, showing exactly how to structure your investments, manage risk, and maximize returns to reach the $10,000 milestone and beyond. Congratulations! By now, you've learned everything from the basics of investing, ETFs, tech stocks, and dividends, to high-risk strategies, emerging trends, advanced portfolio management, risk protection, and growth maximization. In this final chapter, we'll tie everything together into a comprehensive step-by-step action plan for 2026, giving you a clear roadmap to turn $100 into $10,000 and potentially much more. 1. Step 1. Establish your investment foundation. Start with a core portfolio of stable assets. Allocate 60 to 70% to broad market ETFs like S&P 500 or total market index funds. Include 10 to 20% in dividend-paying ETFs or individual dividend stocks. Keep 5 to 10% in cash for emergencies and market opportunities. This foundation ensures stability and steady growth, protecting your portfolio from major market swings while providing a reliable base for high-growth strategies. Step 2. Implement dollar-cost averaging. DCA. Set up automatic contributions to your investment accounts. For example, $50 per week or $200 per month. Automatically reinvest dividends and interest. This ensures consistency and harnesses the power of compounding. DCA removes the stress of timing the market, keeps you disciplined, and gradually builds your portfolio over months and years. 3. Step 3. Allocate to high-growth opportunities. Once your foundation is set, strategically allocate a portion of your portfolio, 10 to 30%, to high-risk, high-reward investments. Emerging AI or tech startups, niche ETFs in biotech, AI or clean energy, carefully selected cryptocurrencies or blockchain projects. This portion serves as your growth engine, boosting potential returns without risking your core portfolio. Step 4. Monitor and rebalance quarterly, every 3 to 6 months. Review your portfolio performance. Rebalance to maintain your target allocation. Adjust contributions toward high-performing sectors or underweight areas. Rebalancing keeps risk in check and optimizes growth opportunities, ensuring your strategy remains aligned with your goals. Step 5. Protect against risk. Use the risk management strategies you've learned. Diversify across assets, sectors, and geographies. Set stop-loss orders for high-risk investments. Maintain cash reserves. Stay informed on market trends and emerging technologies. Protecting your capital allows your portfolio to weather market volatility, keeping your investment plan on track. Step 6. Maximize compound growth. Reinvest every dividend, interest payment, and capital gain. Even small reinvestments magnify returns over time, especially when combined with DCA and high-growth allocations. In 2026, sectors like AI, clean energy, and biotech are expected to grow rapidly, making reinvestment even more powerful. Step 7. Leverage emerging 2026 trends. Stay updated on cutting-edge opportunities, AI-driven tools and startups, renewable energy breakthroughs, automation and robotics innovations, decentralized finance, DeFi applications. Allocate a portion of your high-risk investments to these trends to capitalize on early adoption growth while keeping your core portfolio safe. Step 8. Maintain discipline and patience. The most important element of success is consistency and emotional discipline. Avoid panic selling during market dips. Don't chase hype or speculative fads without research. Stick to your action plan, even during volatility. By combining discipline, strategy, and the power of compounding, your $100 can steadily grow toward $10,000 and beyond. Step 9. Track progress and set goals. Set measurable goals for 2026, monthly contributions, and portfolio growth targets. Performance benchmarks for high-growth assets. Long-term milestones for total portfolio value. Regular tracking helps you stay accountable, adjust when needed, and remain motivated on your journey to financial growth. Step 10. Celebrate wins and iterate. Finally, recognize your achievements along the way. Every milestone, whether your portfolio reaches $500, $1,000, or more, is progress. Review your strategy, learn from successes and mistakes, and iterate for continuous improvement. Each year, refine your allocations, explore new trends, and maintain your disciplined investment habits. By following this comprehensive roadmap, you now have a clear, step-by-step strategy to turn $100 into $10,000 in 2026. You've learned to build a stable investment foundation, leverage high growth and emerging opportunities, manage risk and volatility, maximize returns through compounding and disciplined investing. Remember, success in investing is a marathon, not a sprint. By staying consistent, informed, and patient, even a small investment today can grow into a significant portfolio tomorrow. Your journey doesn't end here. It starts now. Apply these strategies, stay disciplined, and watch your $100 investment transform into financial growth and freedom in 2026.